In this class, we are going to talk about the math behind successful trading. Because if you don't understand this, it doesn't matter how well you do everything else, you are never going to win. I'm going to show you a bunch of different concepts you probably haven't seen before and show you how to actually play this game in a way that makes you win. So the first big misconception that we need to talk about is people's perception of trading as a game of skill. Now, the majority of traders spend the majority of their time trying to master sniper entries or technical concepts, but these are not the things that actually make you win. Now, sure, being skilled is good. If you can take great trades, then you're going to win trades more frequently. We all like to do that, and that will be positive for your probabilities-based system. But it's actually the probabilities and the mathematics behind the scenes that decides whether your account grows or completely burns to the ground, okay? So that is why we need to focus in on probabilities and maths. That is what we're going to be doing in this class. So we're going to start with this very simple point. Now, I'm sure you've heard this before, that money is made over large samples of trades and not over individual positions. And while you might have heard it, you might not fully understand it, or you might not put enough attention on it. So I want to bring you to where you are day to day when you take trades, to reflect upon this for a moment. I presume when you take a winning trade, you probably feel rather excited and you feel like you're succeeding. And when you take a losing trade, you probably get kind of angry. You feel a bit frustrated and you're annoyed that the trade lost because now it's set you back. You judge your trading performance and your abilities as a trader off of these individual wins and losses. But if you think about it, what does it take to win a trade and what does it take to lose a trade? Well, it's a 50-50 coin flip. You either buy or you sell, and then the market goes up or it goes down. So judging your trades off of these individual outcomes is really not a good idea, because at the end of the day, anyone can win a trade and anyone can lose one. But only some people with the right system in place can make money over the long term. Now, what we need to do is eliminate our need to be right, which is what most people operate from. It's kind of ego driven, and instead focus on building something we call positive expected value, or for the case of this video, you'll probably hear me refer to it as plus EV. So when I say that, that's what I mean. Now, positive expected value is basically a way of building our trading that will essentially naturally print positive results and profits over time, providing we follow a strict system, okay? And that is what this class is all about. It's about building this positive expected value into the way that you trade. So let's begin by talking about expectancy, because this is the metric that matters above all else. So what exactly is expectancy? Well, it's how much you make or lose per trade. And this includes your wins and losses. So you can think of this as a new way of calculating your individual trade performance. Rather than looking at every win you took and every loss you took, we can actually condense everything down into an EV number, or an expected value, okay? So to do this, we have a simple formula. And in order to work out the expected value of your system, you are going to need the performance of the past, say, 50 or 100 trades you took. Now, if you don't have this, that is absolutely fine. And I presume most people won't, because most people don't track their trading. But throughout this video, I'm going to show you how to build a system that has positive expected value so that you can build one, test one, and then come back and fill in this equation to work out your expectancy to see whether you are a profitable trader or not. Now, what I would like you to do is follow what we're about to explain with just the past few trades you've taken to see what your short-term expectancy looks like based on the trades you've got. Now, the more data you've got, the better, but I don't expect most people will have a whole lot. Okay, so to calculate our EV, we follow this little equation. We get our win ratio, so how many times we win out of one. So if we win 50% of our trades, that would be a 0.5 win ratio, okay, for example. And we times that by our average win size. So if our average win size is $2,000, for example, and then we minus from that our loss ratio times our average loss size. And the number that we get is our expectancy. So let's take a look at an example. Here is an EV formula for a 50% win rate with 1 to 2 risk reward. So this means this trader is winning half the trades they take, and they are making $2 on a win, or in this case, $2,000 on a win, and they are losing $1,000 on a loss. Okay, so they're trading with a 1 to 2 risk reward ratio. So how we do the formula then, we have a 50% win rate. So the ratio is going to be 0.5. So 0.5 of all of the trades we take, half the trades we take are winners. And the average win size is $2,000. So then we put that in at the top, and that will equate to $1,000. Then we take our loss ratio, because we're with a 50% win rate. That means 50% of our trades are also going to lose. So we have 0.5 times our average loss size, which is 1,000. That creates 500. So if we then get 1,000 minus 500, the result is $500, okay? Now, if this was complex, let me explain it in a more human form, and then we'll get into how this actually works and helps and benefits you. So if you took 100 trades, okay, this is the human example. Imagine yourself in this situation. 50 of those trades have won. and they have returned to you $2,000 per trade. Okay, 50 of those trades lost, and they took away from you $1,000 per trade. So your 50 winners at $2,000 is equivalent to $100,000 in profits. Your 50 losers of $1,000 is equivalent to minus $50,000 in profits or capital. Okay, so we get the 100,000 in profits minus the 50,000 in losses, and that's going to equate to a $50,000 profit over 100 trades. So instead of looking at trades as wins and instead of looking at trades as losses, we can equate from this that when we take 100 trades with this system, each trade, whether it won or lost in the moment, is worth $500. Okay, that is your expectancy or your expected value. Regardless of whether your trade wins or it loses, it is going to make $500 in EV. Okay, so long term, every trade is just worth $500. Now, if your formula, this formula we've just looked at, actually comes out with a negative expectancy, so let's say it's minus $100, then that means your trading is unprofitable, and you have to fix that before you start trading it live, because otherwise you are burning money. But in this case, of course, we have a positive expectancy, and this is what we need to know so that we can trust our system over time, because we know every single trade we take, rather than looking at it in wins and losses, is just worth $500. Okay, every single win is worth $500, and every single loss is worth $500. Now, obviously, it's not going to look like that in the short to medium term, because you're going to see a week where you've lost 3,000, or you're going to see a week where you've won 6,000. But the maths stacks up, and if you take enough trades with this system, every single action you take will be worth $500 in the end. And this is the way we want to look at trading, because it allows us to just consistently repeat the right system and trust ourselves in the process. Okay, so what we want to do at this point in time, or not quite yet if you don't have enough data to build your expectancy out, is stop thinking about taking trades. So stop thinking about taking great trades and taking winning trades all the time. Instead, everything you do, whether it wins or loses, is just the execution of a $500 decision. And the only thing you need to focus on is executing the $500 decisions, or the decisions that actually create the $500 expectancy. All right. Now, if you have a system already, you can, of course, calculate the performance based on anything you've got in terms of data, in terms of backtests, instead of journals, anything like that. But if you don't have one, that's okay, because we're going to build out how to actually create plus EV decision making inside of your trading. So there are actually many, many different ways to reach the same outcome in trading, right? You see me teaching trading styles on my YouTube. There's probably 1,000 other people doing it as well. And we all trade in different ways. But a lot of us are actually profitable, even though the way that we trade is completely different to that of someone else. And that is because of the different ways that we can build plus EV systems, all right? So there are two primary metrics that will shape your expectancy. They are going to be win rate, so that is how often you win or lose, and your risk to reward, which is how big your winners are in comparison to your losses, okay? So the dream scenario in trading would be, of course, to have a high win rate and a high risk to reward ratio. So for example, we'd like to win 90% of trades, and we'd like to make 10 times more on our winners than we would on our losers. But they have kind of an inverse relationship, all right? So we can't really win often and win big as much as we would like to do that. So this little graph here that I put together kind of shows the disparity between high risk reward and high win rates. Okay, I want to start from the top here. So your risk reward being 10, so that means you're making $10 for every $1 you risk. Sounds like the dream situation, but generally, the further you try to extend your targets, the lower your win rate is going to be. And the simple reason for that is because you are having to hold your trades for ages, so there's bigger risk of them turning around, and you have to have small stop losses to achieve these big risk rewards, which increases the risk your stop gets hit. Very simple, basic stuff, okay? But that means the higher the risk reward we go, the lower our win rate is generally going to be, right? Imagine if you were risking 10 pips to make 1 pip, you're going to win almost all the trades you take, but you're probably still not going to be profitable, because if you lose 1, it wipes out 10 winners, okay? But this is the other extreme of that. The bigger your risk reward, the lower your win rate's going to be. So although you're making $10 for every $1 you risk, you might only win 1 in 10 trades, which means essentially you're going to be break even, okay? So likewise, the other way, yeah, 1R, if you're going for a $1 risk to make $1 return, yeah, you'll get a high win rate, maybe 70% or so, but it's still not entirely going to be optimal, although it is possible to win that way. So let's talk through some of the different ways that you can achieve the same outcome in trading, or a similar outcome at least. Now, if we have risk reward of around $8 or $9 or $10, we'll call it $8. Generally, our win rate is probably going to be in around the 10 to 15% mark. So if every trade we take does not close at take profit until we have made 8 times what we're risking. So if we have a 10 pip stop and 80 pip target, we're not going to win those trades very often at all, 20% or less of the time, probably closer to 10 or 15, simply because, as we've said, those trades have to go so far without coming back a tiny distance for our stop. So we're not going to have high win rates with this. But if you think about it, and we'll talk through the expectancy in a moment, even if you lose 8 out of 10 trades, this is pretty much, still borderline profitable, because you win 2 trades, you make 16% or $16 there. You lose 8 trades, you're going to lose $8. So you're actually still making good money, even though you're losing 8 out of 10 trades with a system like this. So there's one way to reach the same outcome, right? Now this one, if you go for 6R, so you're making $6 for every $1 you risk, you'll get better risk reward with this, or better win rate, should I say. Probably around 30% long term. It's still quite a large target, but it is realistically achievable around 3 out of 10 times. So you're looking at 7 losses, 3 wins, but you're making $6 for every win and only losing $1 for every loss. So this is actually a pretty good way to trade, though it does have, of course, some up and down swings. Now this is my favorite way to trade. This is the way that I think is best. This is a risk reward of 3. We'll talk why I think this is the best. You don't have to listen to me, you don't have to copy me, but I like this. So you're looking to make $3 for every $1 you risk. And when you're trading this way, you can achieve win rates of around 50 to 55, sometimes up to 60% with this trading style, okay? So my long term has actually been around 62 to 64%, but I go for 3R pretty much all the time. And that is exceptionally high for 3R trading, but it's because I trade a low frequency of trade. So if you're day trading with this and you're trading more frequently and you don't have 10 years of experience behind you, then your win rate's probably going to be in around the 45 to 55% mark for 3R trades, and I like that. Now this, again, is profitable. All of this is profitable, okay? It doesn't matter which approach you take. All of these ways make money. If you can achieve a 1-to-1 risk reward with a 70% win rate, that's fine, that's profitable, it works, okay? Now some are more optimal than others, of course, and we're going to do that by talking through the expectancies. I'll show you the expectancy of each of these so you can see which one's better, or, well, subjectively better, which one you prefer, and the expectancy of each of those, okay? So with this first one, an 8R at around 15% win rates, or 13% win rate here, the expectancy of this is going to be $170 per trade, wins and losses included. So that means of the, nearly 9 trades out of every 10 you lose, you're actually still making $170 per trade, because when that one big one comes along, you make a lot of profit, and it wipes out all the losses, and actually ends up being positive expectancy across all 10 trades. So this one, with a 6R and a 30% win rate, so winning 30% of trades for $6 return at $1 risk, this has a $1,100 per trade expectancy. So this is actually a massive jump up, right? And this is presuming, by the way, that we are risking $1,000 per trade on all of these. So this is a massive improvement, right, over the previous one overall, because you are simply winning more frequently and your winners are still of a reasonable size. Now this one, my favorite, this is the way that I trade personally. This is a 55% roughly win rate of trades at 1 to 3 risk to reward. Now this one actually has a $1,200 per trade expectancy at $1,000 risk, because overall you are winning 3 times more than you lose when you do win, and you're winning around half the time, okay? Even if this was 50% or 40%, it's still a very good expectancy. And this trader here with a 70% win rate, but only taking 1-to-1, so risking $1 to make $1, actually has a rather low, but still acceptable expectancy, because they are just winning so frequently that it overcomes the fact that their win size is very small. Now you'll have noticed something there when we went through those, and that is that there's kind of a bell curve, okay? If we look back on these, the very high risk reward low win rate has around a $170 expectancy. The other two in the middle, the 6R and the 3R, have a very high expectancy of over $1,000 per trade. And then the final one only has a $400 per trade expectancy. Now, both of those are fine, but you'll see that the middle risk reward, so neither of the extremes, not too high, not too low, actually seems to, take the cake, should we say, in terms of the returns that it can make, or the expectancy that the system achieves, because it's just winning more frequently at a more modest, but still pretty notable risk to reward. So you're making good amounts of money on each trade, and you're making a lot more winning trades as well. All right. So that is why I like this range between 3 to 5 to 6R with around a 35 to 55% win rate. Around there, I think is the sweet spot for trading. So let me show you what this looks like when you're actually trading with these metrics, so you can see why I like this kind of sweet spot area. Now you don't have to trade with it, but I'm going to explain to you kind of why I choose this and why you might like this as well. So if we look at the high risk reward and low win rate style of trading, so this is the person who's making 8 to 10% per trade, but is only winning around 1 in every 10 or 1 in every 8 trades, they have this kind of swingy system pattern where over time, if they take enough trades, they will be profitable. But it's this constant grind of huge win and then loads of small, horrible, debilitating losses that just keep happening for weeks on end until the next big spike again, all right? So although it is profitable, and if you do it enough, you will win, I find it incredibly stressful and I don't really like it. Now, if we think about the low risk reward, high win rate, so this is someone taking 1-to-1 risk rewards with around a 70% win rate, this trader is actually doing just fine, okay? It's okay, it's pretty steady, pretty sideways, and the positive win rate is quite nice to see because it consistently moves you to the upside. Now, the medium risk reward and medium win rate trader, of course, pretty much looks the same. You'll see there's a few more losses mixed in there. However, if you take a look at the figure at the end, so we have a 20% return after 20 trades here, so that's a 1% expectancy per trade. Compared to the low risk reward and high win rate trader, this trader has made under 50% of the returns that the medium trader has made. And the reason for that is simply because the profits we make on our winning trades with this system are significantly larger than the trader here. So although they're winning 2 or 3 more trades out of every 10 than this trader, they're winning significantly smaller, which means it's a little bit of a slow grind to the top, okay? Now, all of these ways are profitable approaches to trading, and the mathematical element is fine, but it does miss one thing, and that is human interference, because unfortunately, we're quite stupid. Humans are not really built for trading, and that is why people struggle so much. And if you start to interfere with your system, that is when things go wrong, and that is why I need to cover this now, because you've got to understand this, okay? So when we have this high variance way of trading, with lots of tiny losses and then some big, huge spikes, if you traded this way long enough, you would be completely fine, and you would make money because it's a profitable trading system. But it comes with big swings up and down, weeks of compounded losses, sometimes months, and all of your profits are made in big spikes, which is incredibly hard on your mentality, and it requires extreme emotional resilience to do. It's pretty unforgiving because missing your one win can put you in a 20 trade losing streak and a deep financial hole that, yes, is recoverable if you follow your system, but when you get to that degree, you're probably going to be feeling too stressed to actually do things properly, okay? Now, with the high win rate, low risk reward trader, this trader has thin edges. So it's kind of easy to fall into break even or losses because if anything steadies out, let's say you have a mistake, you make a mistake one day, or there's macroeconomics which mess up one of your trades, well, now your edge is kind of gone. So it's easy to get stuck and it's hard to break out of a break-even trap or losing phases when you trade in this way. Now, this, of course, is why I like the middle system, because when you're trading 1 to 3, let's say, and you're winning around half the trades you take, you've got a lot of room for error. Because if you go into slight drawdowns, it's very forgiving. At 1 to 3 risk reward, if your win rate slips from 55 to 30% for a phase, you're actually still profitable. Sure, you'll be grinding along without making too much profits, but you are still profitable, and that's with a pretty much almost 50% decline in your win rate. So you can see kind of why I prefer this style of trading. It allows you to make mistakes without being crushed, and it allows you to win still through unforgivable market conditions. So when markets aren't looking great, you can still actually pull returns because you don't need huge win rates to make this happen. So these are the different approaches you can take, and all of them can mathematically work. What I suggest you do is pick the approach that you personally can execute consistently, but hopefully my insight has helped you to some degree to work out which one I prefer at least and which one you may prefer as well. If you decide to operate with high risk reward and low win rates, you have to expect very large profits, but in phases, and lots of very small losses. So this is a style of trading for someone with a high risk tolerance who just likes those big wins and doesn't mind sitting through the big streaks of losses without losing their minds and breaking the rules. A low risk reward, high win rate trader, you're going to be completely fine for the most part, but you will have quite a lot of break-even phases where you're stuck for a week, a few weeks, a few months, just because if your edge thins out due to any market conditions or a mistake you've made, you get kind of stuck at the break-even trap pretty quick. I mean, every loss you take wipes out everything you've made from your previous win, so it's easy to get stuck here, but it is okay. And if you go with the medium risk reward and medium win rates, you've got to understand you're going to be in the middle. Your wins are going to be reasonably sized, but they won't be huge like the high risk reward trader. Your losses are going to be a lot less frequent than that trader as well. And the wins will still be considerably larger than the low risk reward trader. So you either go middle ground or one extreme or the other. Okay, it depends on your risk tolerance, your preferences, whatever you're going to be able to execute consistently without breaking the rules. So those are the 2 core metrics that you need to build your trading system around, okay? Win rate and risk to reward, and you pick whichever one of these is going to be best for you, your preferences, and your risk tolerances. Don't worry about this just yet because there's a few more things we have to get through, but this is what you're going to come back to help to refine or build out your system so you can win mathematically, okay? So now you know that trading is indeed a math game. It is simply just balancing those different metrics we've built to actually create plus EV through the probabilities of the market. There's something that I never hear anyone talk about in the trading world, and I learned this initially in poker because I play quite a lot of poker, but it crosses over to trading as well because it's here too, even though no one talks about it, and that is variance, okay? And this is the idea that you don't get to choose your results. Now, this of course sounds scary. It actually makes a lot of sense, and understanding it will help you quite a lot. If we think back to that equation we did on expected value or EV, we created the value of every trade we take by summing up our average winners and our win rates and our average losers and our loss rates. And that gives us our expectancy number. Now, over time, this number is what we are going to make. But the expectancy forms over large samples, right? We're not actually, in the short term, going to see a $500 return when we take a losing trade. Neither when we see a winning trade. Our wins will be bigger, our losses will be bigger as well. Over time, of course, this is created, but in real time, that's not what we see. So in the short term, when we're just looking at today or this week's or this month's profit and loss, realistically anything can happen to our equity curves, and that can be rather stressful. If we take a look at this group of traders, this is a simulation showing, I don't even know how many, probably 100 or so traders trading the same system. With the same exact system, each of these traders gets different results. Every one of these lines is an individual trader, okay? This green line trader did very well. The blue line trader traded around the middle of everyone else, and this red line trader, even though they traded the exact same system as all of these traders, performed significantly worse, though they did still end up in profits. So, what do we derive from this? Well, just because you're trading the same system and you're following the same rules as someone else does not mean your results are going to be the same, because with something that builds expectancy, we are dependent on essentially the luck factor of whatever the market's going to provide us in terms of trades in order to amplify the performance. If you trade a profitable strategy, then you will be profitable, but you don't get to choose by how much profit you will make, okay? Now, obviously, there are workarounds to this. You can get more funding, more capital to actually amplify your profits. In the short term, what I'm trying to say, anything can happen, okay? You can't choose exactly what's going to be the outcome. You can only choose the inputs you put in to determine whether the equity curve goes up in some way, whether that's massively or slightly, or if it goes down, which obviously we don't want to do. What is the effect of variance then? Well, it simply means you can do everything right and still lose money in the short term. And you can do everything wrong and still win money in the short term. And the big danger of this, and why I'm presenting this to you, is because it affects a lot of people when they are trying to start out with a good trading system. So, if you have a weak trading system, something you've just picked up, and you haven't really tested it out too much, you can be fooled into thinking that this works by the fact that it's gone up for a few days or a few weeks or a few months and you've made money. Because over time, the expectancy of this system could be negative, and this could actually be basically a confirmed losing system that eventually is going to take away all your money, but you just don't see that yet. So you commit to something that doesn't truly work. There is also strong system variance, which can sometimes work against you to trick you out of very good systems and very good ways of trading. And I'm sure this has probably happened to you in the past. So you start trading with a system, and the system works against you, or at least it looks like it does. You lose 3, 4, 5, 10 trades in a row, and you think this sucks. This absolutely does not work. I'm going to abandon it. However, if you stayed with it, providing it had plus EV, which some systems you've probably traded have, would have turned into, eventually, consistent upward moving equity curves and returns. Because you bailed on the system too fast, you don't get to benefit from that. This happens because of variance. Whether or not the first 10 trades you take with a new system win or lose is completely out of your control. You do not get to choose that, okay? You just take the trades and the market decides what happens in the short term. But if you keep taking the trades with this system, then you essentially decide what happens over the long term. That is the disparity that most people miss. Because markets are unpredictable and they can act irrationally, you can do the right thing, you can do everything right, and the market will work against you for however long it wants to. Now, eventually you'll come out on top, but this can fool you into trading in a negative EV way by the short-term results of today. So this is probably how it's affected you before. If you think about a system you've tried to trade and it just didn't work for you over the span of a few weeks, causes you to jump ship too fast on systems that do work and go back to gambling that doesn't work because it wins today. You know, you get those short-term wins, you feel that dopamine hit, you feel good. You keep doing this even though realistically you know this is guaranteed to fail you. Okay, that is the big danger of variance. You can't actually eliminate variance from trading because we are trading in an unpredictable market. The only thing you can do is outlast the variance. The trader who wins isn't the one who avoids drawdown, it's the one who can keep safely executing through it. To do that, you have to have your plus EV and everything else we're building out in this class. So take a look at this trader, for example. This is a system with a 50% win rate and a 1 to 3 risk to reward return. Over 10 trades, the trader is completely break even. They go up, they go down, they go up, they go down. They've made no progress. And in the short term, let's say this was over the span of a week or a month, the trader was almost certainly believe that this strategy does not work at all. However, we've looked at the expectancy of this system and we know that it works. Take a look at this trader. This is the same exact system, a profitable system with a positive expectancy, but after 10 trades, all they've actually done is lose what, like 6.5%, 7% here? Obviously that doesn't feel good in the short term, and it would lead you to believe that this system absolutely doesn't work because all you've managed to achieve in the first 10 trades is just a massive loss, right, of nearly 8%. However, if we were to get this exact same chart and zoom it out over 100 trades, we see that tiny little hiccup we see at the start, a downswing that looked so terrible here. It's actually just the start of a massively profitable system that's actually ended with an 80% return over the span of 100 trades. That is the variance I'm talking about. The fact that short term can look like everything's going wrong, even with a system that long term will pay you well. And this you need to understand because this is going to help you to stick with systems that probably do work that you just simply don't trust in the short term. You're not going to know if your system works on the first 10, 20 or 30 trades that you take. The best thing you can do is test your system in a simulation, and that goes for everything I'm teaching you today. This is also a great way to find your EV and find out whether your system works. Using a backtesting software now, I'll put a link in the description to one, but that's really not the core focus of this video. I just suggest you go and do that potentially after you've learned about all the math, okay? If you do this, you'll be able to build your EV outs and you'll be able to see how a system performs through upswings and downswings and whether it's profitable over time, which will give you data, confidence, and experience when it comes to applying it live. You can then confidently trade through drawdowns and variance in real markets with real money because you know your expectancy and you can simply trust the process. If you don't understand and respect variance, like you probably don't now, run into problems where you up your risk after losses, you change your approach to trading and break your system rules, and you'd be too results focused in the short term, freaking out over 3, 4, or 5 losses in a row. And as soon as you do that, the edge that actually creates these profitable mathematics completely falls apart. The trading that would have naturally recovered actually ends up spiraling into a total wipeout without an understanding of variance. So another thing that ties into the point of variance, and the next point for this class, is gambler's fallacy. This is a misunderstanding that destroys your edge entirely. Some people believe, and this is very, very common, that past outcomes are going to affect the next independent outcome that happens inside of the market, right? So let's say your past 3 trades were losses. At this point, a lot of the time you can think, I couldn't lose again. I couldn't possibly lose another one in a row. Then you start to do things like double down or take weak setups that simply really aren't very high quality, or you make deviations from your strategy because you're convinced that the next trade has to win due to the fact that the previous trades lost. That's not entirely true. Now, in reality, the next trade could lose, and so could the one after that, because every trade is a random distribution. Every trade has no bearing on the outcome of the next. Now, this is true for winning trades as well. If you've won a few trades in a row, that doesn't mean the next one has to lose. It means you could just continue winning. So all you should do is keep trading the system as standard, okay? The only way you can survive in these markets, get through these phases, wipe out that gambler's fallacy, survive the variance, and trade with plus EV is to follow a structured plan and then execute it regardless of short-term results, right? Markets, trading can be exceptionally unforgiving in the short term. Long term, if you do everything right, you have that plus EV, everything will iron out over time and you will do fine. You'll have your losses, you'll have your wins, and natural balance will take you to success over time. Now, we've talked through expectancy, risk reward, win rates, variance, and gambler's fallacy. But there is one variable that makes or breaks absolutely all of this. That is going to be risk control. This is the thing that decides whether you win or lose, even if you understand everything else. So if you want to build any level of balance, like what we've discussed so far in terms of the risk reward and win rates, you generally are going to need your wins to be larger than your losses. Now, not just in the risk reward sense, But essentially, we have to make sure that our loss, our risk is the same on each trade. So there's consistency in the expected outcome, right? Because if you risk $100 on one trade and then $300 on another, well, now your average loss is all over the place, and it's going to be harder for you to achieve the same level of consistency and therefore a good expectancy, okay? So you need to build a simple and effective risk plan around this to account for this fact. And the way we're going to do that, very simple, is just work with fixed percentage-based risk per trade, okay? Okay, so fixed risk per trade in percentage is what we're looking for. So what we want to do when we're trading is make sure we are dynamically changing the position size of our trades to ensure that every single stop loss that gets hit is equivalent to the same exact percentage risk, okay? So, for example, if we had two trades in the market, we have a big one like this and a small one like this, what some people will do is they will use the same position size for either of these trades, and then the bigger the pips stop loss, so this one, for example, is around 15 pips, and this one's around 6. The bigger the stop loss in pips, the more money you lose. Now, this creates trouble when we're trying to actually consistently repeat the same risk profiles for our risk reward and plus EV system. So what we can do is, instead of using the same position size and varying pip stop losses, we can use varying pip stop losses, but we can switch the position size up. So for this trade, the position size would be smaller than it would be for this trade. And that means the stop loss here is worth minus 1%. And the stop loss here is also worth minus 1%, even though the stop loss is over twice the size, okay? Because when we do this, we know that every single trade we take is going to either lose a fixed percent, the exact same percent on every trade, like 1%, or it's going to win 3%, 4%, or whatever plus, right? Likewise, we can see here this target is very big and this target is small, but because we use that fixed risk per trade rule of 1% risk per trade, the profits you accumulate on this small position are actually bigger than this one, right? This is around 4.07. This is 4.47% that you would return on this, even though the trade target is a lot smaller. It's about just under half the size, simply because we are using dynamic position sizing to lock in 1% risk, okay? So that is how it works, and that's why we want to do it. So there's actually a super simple way to calculate position sizes. Just go to my FX book to a position size calculator. There's a lot of position size calculators out there, but this is basically how they work and the one that I generally use. You type in your currency pair. So if you're trading Euro USD, just type in Euro USD. Your account currency, put it to whatever you're trading. Let's say we've got a $100,000 account. We then type our account size in there, 1% risk, and then we put how many pips our stop loss is. So let's say we have a 15 pip stop. Click calculate, and it will tell you exactly the position size you want to risk on this account in order to risk 1% or $1,000, okay? Now, if you change the size of the stop loss in pips, the only thing that's going to change is your position size. It's always going to keep the risk fixed. That is what we want, because that helps us to achieve that consistency in the risk to reward profile, so we can achieve that plus EV. Okay, so with that fixed percentage-based risk per trade, what we are doing is simply ensuring that whether our stop loss is 50 pips, 7 pips, or any other size, we are only risking the same exact risk per trade of, say, 1% on every single trade we take, which makes our trading stupid simple, forces natural consistency inside of our EV, and it allows us to control a very important metric, which you probably haven't given enough thought, and that is your risk of ruin. So risk of ruin is the chance you go broke before your edge has time to work. Now, because of the variance factor in trading, there is always a possibility that you lose all of your money in the markets and go broke, and that will be the end of your trading career. Now, this sounds scary, because now you're probably thinking, well, am I gambling at all? But not really, no. If you actually set up your risk control kind of factors inside of your system to account for risk of ruin and to minimize it as small as possible, you could take a risk of ruin from, say, a 1 in 5 chance of losing it all to a decimal point so small that it is practically impossible to hit this at all, okay? So you can make risk of ruin practically negligible, pretty much completely zero, but you have to make sure everything's set up in the right way. Okay, so we're on a risk of ruin calculator on a website called tradesearcher.ai if you want to go try it for yourself. What we're looking at here is basically the risk of losing 50% of our account or more by trading different strategies, okay? So we've plugged in the 3-to-1 reward to risk ratio, and we've plugged in the 50% win rate. If we work with 1% risk per trade, we can see that we have a 0% risk of losing 50% of the account. The maximum drawdown we would realistically achieve with this system, the one that I suggest and like myself, is around 20%. So even if you got into a very bad situation, it's very, very unlikely that you're going to lose anything more than really 25% before you make a full recovery. This is over 1,000 simulations as well, okay? So if we have 2% risk per trade, you can see that this does still realistically have a very low chance of losing half the account, but the maximum drawdown jumps to 41.55%. That is very difficult psychologically and not a situation that you really want to find yourself in, because trying to crawl back when you've only got 60% of your account left is not really going to be very nice, okay? It's difficult on your mind and you're probably going to mess up and then end up blowing it all. Now, if we look at some of the risk per trade that some people use, like 5%, well, now things get serious. The odds of hitting a 50% drawdown is 1 in 2. In fact, it's more than 1 in 2. So there's over half chance that you lose half of your entire account balance, which is really why it's so important to control this risk of ruin. Because if you're going to trade for any amount of time, then you are going to run into these drawdowns and these difficult situations, and you don't want them to be taken 50, 60, 70, or 100% of your account away. Okay, so if we were to change this up, let's say we have a win rate of 20%, but our risk reward is 8, then again, we have a lower risk of ruin, okay, but it is possible that we could lose that amount. Now, this is with that higher variance way of trading. Now, let's say our win rate is 70%, but our risk reward ratio is 1. So the other extreme, if we calculate this, we have a low risk of ruin, a low maximum drawdown for this style of trading as well. So this kind of equates to that medium point that we discussed. However, of course, as we know, this may not be consistently achievable for a super long time horizon, and the returns are going to be much smaller here as well. Okay, but this is still a much safer way to trade than those higher variance approaches of super high risk reward, super low win rates, and it's certainly better to just have that risk per trade dialed in to around 1% to keep your account safe. So you can make your risk of ruin negligible if you have a good percentage risk per trade in place, and you have to do this if you want to trade for a long time without losing all of your money, okay? So I suggest, as you probably guessed, 1% risk per trade as standard for pretty much all traders. This is enough to make good returns without having a high risk of ruin at all. It's up to you to decide based on what works for you, your risk tolerances, and your expectancy system, but 1% is a solid baseline to begin with. Now, on this topic of risk of ruin, losing streaks will take place. It's guaranteed that at some point you will go on what we call a downswing. It could be 5 trades, could be 10, or it could even be 15 or 20 losses in a row in a very bad case. Now, when it comes to handling losing streaks, it's actually quite easy. Providing you have a plus EV system in place, which is what I'm helping you to understand today, the answer is simple. You just trade normally and you will naturally come back from any losing streaks that happen. Now, one thing I do suggest is reviewing your trades for human error to avoid any unnecessary drawdowns that you might be running into due to mistakes that you're making. But if you don't see any obvious errors, it's just natural. All you have to do is stay on track with the system and do not deviate, because as you've learned throughout this class so far, it's all down to the math. And it's important to remind yourself, if you are on a drawdown, that factor we discussed on expectancy earlier. You're not taking $2,000 wins and $1,000 losses, or whatever those figures are relative to you. You're just executing $500 decisions, okay? So if you see losses amounting and they're not completely out of control, but it's not making you very happy, just remember this is one part of the bigger system, providing you're still doing everything properly. So here is a chart showing a 20 trade losing streak. This is a huge losing streak. This is like, you probably won't actually hit a 20 trade losing streak, but if you do, you can still see that within the span of 75 trades, so in just 40 trades after the losing streak ended, with a 1 to 3 risk reward system, that loss is completely recovered. So this is how insignificant losses and losing streaks actually are when you have a system in check. Now, the interesting thing about this is only a 37% win rate, and this is with a 1 to 3 system. Okay, so you can see that this is literally like kind of low win rates and medium risk reward, but still, after 75 trades, a 20 trade losing streak is wiped out. And if we exclude the losing streak, it's still only a 50% win rate outside of that. So half the trades are won, half the trades are lost, and then there's a 20 trade losing streak added in the mix, and we still end the 75 trade sample profitably, right? So you can see how important this is and how useful it is to have these systems in place, and how kind of silly it is as well to worry about losses and individual losses and small losing streaks. You can recover a 20 trade drawdown in the span of 40 more trades, all right? So losing streaks will not be an issue if you have a reasonable risk per trade of 1% or less in place, But if your risk per trade is higher, then in the worst case scenario of a 20 trade losing streak, your account can be completely wiped out. So losing streaks are only bad really if your risk per trade is too high. At 1%, even 20 trade losing streaks are recoverable, and a standard streak of 3 to 6 losses is practically unnoticeable after you've taken 1 or 2 winners. This is why you need to be set up for the worst case scenario, because losses and gains are not symmetrical in percentage terms. The bigger your losses, the harder it becomes to recover. If you lose 10%, you need an 11% return on your existing account balance to recover. If you lose 20%, you need 25% of your remaining balance in returns to recover. And if you lose 50%, you need to make a 100% return to recover, right? So it's skewed against you. Recovering 25% is doable in the worst case situation that you go on a big drawdown, but if you lose 50% or more, this is very hard to come back from. So it's important that you control your risk per trade and everything we've discussed around risk of ruin, losing streaks, and all of this on top of the plus EV system that we've built up to this point. So let's recap everything really quick. Number 1 is the expectancy. This is the metric that matters the most. You want to determine your expectancy, and everything else is going to be built around that. Now, in order to achieve the expectancy, you need, of course, this balance of risk to reward and win rates. So I like the sweet spot of 30 to 50% win rates and 1 to 3 to 1 to 5 R. You can determine the win rate or risk versus reward balance you'll be building your system around. Then remember variance and detach your focus from short-term results, because realistically we can't decide what the market does this week or even this month. So all we can decide is how well we apply a system that will print positive results over time. Before, gambler's fallacy. So remember that every trade is a completely random distribution. Just because the past few trades won doesn't mean the next one's going to lose. And just because the past few trades lost does not mean the next one is going to win. Number 5, your risk per trade. Determine your risk of ruin, test to find your maximum drawdowns, and build your risk per trade percentage around these elements. You want to build your risk control to be ready for drawdowns, because one day they will come and you don't want to be destroyed by them. And that is pretty much everything you need to know about the math behind successful trading. So this has been a long class. If you're still here, you're probably going to do well, because it was probably boring and long and tedious. You've probably learned a lot as well. Now, if you want to learn even more, the link in the description to watch a class where I'm going to teach you to break your bad habits and misconceptions and actually start trading in the right way by building a system that works for you. If that's of any interest, I hope you enjoy it. And if not, I hope this class has been beneficial to you and helps you to see trading in a different light. Now, you can take all of this boring math stuff I've just taught you, put it into action, and make this happen for yourself. So thank you for watching, and I'll see you in the next video.